Hello everyone, Crypto Newsreader here. I hope you're all having a fantastic day. Today is Monday, July the 3rd, and I've got some exciting news stories to cover today, so I hope you stick around. Here are the headlines we will cover today. False rumors of SEC's Gary Gensler resignation is fueled by AI. Cameron Winklevoss slams SEC's Bitcoin ETF rejection. On-chain data suggests the rise of long-term BTC investors. MasterCard says its multi-token network, MTN, will drive mainstream blockchain adoption. Ripple v SEC case update. Institutions pour capital into Bitcoin and altcoins, creating positive net flows for 2023. 4 US banking giants now have $205 billion in unrealized losses sitting on their balance sheets. Miners send millions to exchanges. BlackRock Refiles for Bitcoin ETF after SEC flags flaws. Bittrex accuses SEC of failing again to define securities. So, let's get into it. False rumors of SEC's Gary Gensler's resignation fueled by AI. So, false rumors about SEC Chair Gary Gensler's resignation spark crypto community uproar, fueled by AI-generated misinformation, which is what was expected with this AI-generated videos and things. False rumors regarded the resignation of Gary Gensler, the US Securities Exchange Commission (SEC) chair, have once again caused a stir within the crypto community. This time, however, artificial intelligence seems to have played a role in generating and propagating misinformation. Over the weekend, news stories claiming Gary Gensler's resignation began surfacing on several smaller crypto outlets. One particular website, Crypto Alert, published an article titled "SEC Sources Confirm Gary Gensler Resignation," which was subsequently copied and shared on various platforms, including bearish Twitter accounts like @WhaleChart. However, on July the 3rd, journalists contacted the SEC and unveiled the truth. The news was entirely false. Gary Gensler is not stepping down. Fox Business reporter Eleanor Terrett responded to crypto lawyer John Deaton stating, "My SEC sources are calling BS on this," and confirmed that she had contacted the SEC for an official statement. Fox senior correspondent Charles Gasparino also sought clarification, sharing an email exchange with the SEC's chief PR representative, who expressed confusion at the rumor and ultimately stated that Gensler was not resigning. Interestingly, reports suggest that AI, similar to many other articles on the dubious website, generated the false news story. The crypto community initially responded to the news with elation. Gensler has been perceived as a vocal industry critic, frequently targeting leading companies and their practices throughout the year. Messari co-founder Ryan Selkis expressed his lack of surprise at the rumors, speculating that Gensler's resignation could be a political move to support the current administration in an election year. Selkis suggested that Gensler stepping down could benefit the Democrats, as his stance on crypto-related issues had become a contentious topic that might impact the party's standing in the Senate and key electoral college states. Previous rumors and controversies surrounding Gensler. It's worth noting that this is not the first time rumors of Gensler's resignation have circulated. On April 20th, claims spread that he was preparing to be fired, although these claims originated from questionable sources. Furthermore, on June the 12th, a bill titled SEC Stabilization Act was introduced to the House of Representatives, featuring provisions aimed at removing Gensler from his position and labeling him a tyrannical chairman. So, Gensler sadly is not going to be stepping down from his position, which some of you may be disappointed to hear. Next up, we've got Cameron Winklevoss slams SEC Bitcoin ETF rejection. Cameron Winklevoss, a co-founder of Gemini, has expressed his disappointment with the recent decision by the US Securities and Exchange Commission to reject a Bitcoin exchange-traded fund. According to Winklevoss, this decision is a major setback for investors in the United States. Winklevoss argues that the SEC has been steering investors towards unregulated and potentially harmful cryptocurrency product for the last decade. It has been 10 years since the Winklevoss twins first sought approval for their ETF from the SEC, and on July the 2nd they criticized the SEC for repeatedly denying spot Bitcoin ETFs. And there's a tweet from Cameron Winklevoss that says, "Today marks 10 years since Tyler and I filed for the first spot Bitcoin ETF. The SEC's Gov refused to approve these products for a decade, has been a complete and utter disaster for US investors and demonstrates how the SEC is a failed regulator." Industry commentators have echoed these sentiments, stating that the SEC's refusal to approve these offerings over the past decade has had disastrous consequences for US investors and reflects the regulatory body's failure in its role. Winklevoss highlights that as a result of the SEC's actions, US investors have been forced to turn to risky alternatives like the Grayscale Bitcoin Trust, GBTC. GBTC trades at a significant discount to the actual Bitcoin price and charges high fees due to the absence of an authorized spot Bitcoin ETF. YChart's data reveals that GBTC trades at a 30% discount to the Bitcoin price with an annual fee of 2%, far higher than the average reported fee by Morningstar's research. Winklevoss argues that the SEC's reluctance to approve spot Bitcoin ETFs has driven American capital towards unlicensed and unregulated offshore platforms, including FTX, which he describes as a significant financial scam. Given the SEC's track record, Winklevoss believes the agency should focus on safeguarding investors' interests rather than exceeding its authority and acting as an economic gatekeeper. Several companies, including BlackRock, Fidelity, WisdomTree, Invesco, Valkyrie, and ARK Invest, have recently submitted or updated their applications for a spot Bitcoin ETF. However, the SEC has deemed some of these filings insufficient and lacking clarity, leading the regulatory body to request that fund managers resubmit their applications with clearer text. Meanwhile, Grayscale, the company behind GBTC, is currently engaged in a lengthy mediation process with Gemini, a subsidiary of Digital Currency Group, DCG. Additionally, the SEC has filed several charges against Gemini in court. The rejection of the Bitcoin ETF by the SEC and the subsequent repercussions highlight the ongoing challenges and debates surrounding cryptocurrency regulation in the United States. Investors and industry participants are closely watching for developments that may shape the country's future of cryptocurrency investment opportunities. So, from this, we kind of get the idea that although these ETFs have been rejected, they've not completely been thrown out of the window. There is still a chance that they can be reworked and they will be approved at some point in the future, which is bound to happen. Next up, on-chain data suggests the rise of long-term BTC investors. As the Bitcoin price broke the $30,000 barrier, data shows that long-term investors have risen while showing slow but steady growth. According to data from CryptoQuant, the Bitcoin inflows to exchanges indicator witnessed its most significant decline. Simply put, the BTC supply on the exchanges has dropped significantly. Moreover, per the data, the number of suspected selling addresses on exchanges has plunged by 84% since May 2021 and 80% since October 2021. This shows the possibility of long-term accumulations. In addition, CryptoQuant data suggests that the amount of the BTC supply of exchanges has fallen by more than 30% since March 2020, marking a new record. The current behavior shows a positive evolution as more addresses turn to saving funds in the long run instead of selling on exchanges for a short-term profit. And this is what I always advise with trading and things like that, although this is not financial advice. Long term is better than the short term. Bitcoin is up by 0.5% in the past 24 hours and trading at around $30,700 at the time of writing. BTC's 24-hour trading volume skyrocketed by 37%, surpassing the 11 billion mark as the asset's market capitalization nears $600 billion. CryptoQuant believes that one of the major reasons behind the recent bull run might be the current BTC exchange traded fund filings by some of the largest asset management companies in the world. Fidelity, WisdomTree, VanEck, and many more firms have already submitted their Bitcoin ETF applications. At the same time, the US Securities and Exchange Commission stated that spot BTC ETF filings lack some essential details. Next up, MasterCard says its multi-token network MTN will drive mainstream blockchain adoption. And this is something that we've all been waiting for, so let's hope this will be good. MasterCard's Chief Digital Officer, John Lambert, has stated that the payments giant's newly launched multi-token network has all it takes to unlock the intrinsic value of blockchain technology and accelerate mainstream adoption. MasterCard continues development. While the market capitalization of the global crypto space still stands above the 1 trillion mark, despite the turbulence it has experienced over the past 12 months, MasterCard, a leading payments processor, says the actual value of blockchain technology is yet to be unlocked. In a July the 3rd interview with PYMNTS Payments, I suppose that's supposed to be, John Lambert, MasterCard's chief digital officer, argued that the revolutionary technology's benefits may not go entirely mainstream until there exists the ability actually to develop financially regulated applications powered by blockchain. While many financial institutions have tapped blockchain technology for cross-border payments, trade financing, and more in recent times, Lambert believes that MasterCard's MTN solution will usher in unlimited possibilities and bring more commercial bank money into the blockchain. With scalability still a significant issue for most Layer 1 blockchains, MasterCard claims its MTN solution is designed to shatter that barrier while fostering interoperability and security within the digital assets and blockchain ecosystems. Just like its direct competitor Visa, which recently released its crypto product roadmap, MasterCard has been contributing its bit to the advancement of Web3 movement. As recently reported by Crypto.news, MasterCard has expanded the scope of its Engage program to enable the onboarding of more crypto-focused projects. Earlier in March, the New York-based company joined forces with Stables, an Australian Web3 project, joined forces to launch the world's first stablecoin-only wallet. That sounds hopeful. Let's see what happens when it's released and fully operational. If it really does bring in more money from banks, that could be huge for cryptocurrency as a whole and a big step forward. Ripple v SEC case update as of July the 3rd, 2023. As the cryptocurrency industry is still eagerly awaiting the conclusion of the lawsuit that the United States Securities and Exchange Commission has filed against Ripple, a pro-XRP legal expert has offered more arguments that support the blockchain firm's side of the legal battle. Indeed, lawyer Bill Morgan joined a discussion that included a well-known XRP community member, Mr. Huber, and former SEC enforcement lawyer Mark Fagel, in which the former asked why the regulator filed no injunction at all if Ripple did anything nefarious or even illegal besides selling unregistered securities, in a tweet on July the 2nd, as he further inquired, "What is the point of protecting investors if Ripple can continue to pursue what the SEC considers to be clearly illegal and damaging activities to investors for years after the lawsuit is filed? Shouldn't the SEC have at least tried to file for this for the protection of investors?" In response, Morgan said that the reason for this was that since May 2020, Ripple has only engaged in on-demand liquidity sales, and the SEC would risk finding on a temporary restraining order or preliminary injunction motion that ODL sales, which are the on-demand liquidity sales, are not investment contracts, as it would weaken its argument that the token itself is a security. On top of that, he continued, the SEC would need to show how there is an investment contract when ODL customers who don't invest in the token and don't expect profits and transact the XRP within seconds for fast, cheap cross-border payments, not investments. ODL versus programmatic sales. Earlier, Finbold reported on Morgan shedding his perspective on some rarely raised issues in the community. These included the difference between programmatic sales or open market exchange trades of XRP and sales through Ripple's ODL system that allows customers to move money across borders instantly and at low cost without banking intermediaries. As he said, "My theory is Ripple XRP sales to ODL customers cannot be investment contracts because there is no investment or investment intent by ODL customers and no expectation of profits by ODL customers who hold XRP for a very short time and use it akin to consumption." More recently, Morgan also pointed out the SEC's practices that he said were no way to achieve clarity, stating the example of Dash, which launched in 2014, only for the regulator to suddenly decide it as a security 9 years later, after there was no indication that proof-of-work tokens which are mined were securities. Meanwhile, the XRP token that is the center of the lawsuit was, at the time of publication, changing hands at the price of 48 cents. This indicates a decrease of 0.28% in the last 24 hours, as well as a drop of 0.86% across the previous 7 days, and a more significant 8.77% on its monthly chart as per data on July the 3rd. So the Ripple case could be over before we know it if this comes to, well, being able to prove these points. And I think the longer that the case goes on, the more likely that is, from all the things that are being shown in this case. Next on, we have institutions pour capital into Bitcoin and altcoins, creating positive net flows for 2023. Digital assets manager CoinShares says its institutional investors are bullish on Bitcoin and altcoins as crypto sees over $120 million inflows last week. In its latest digital asset fund Flows Weekly report, CoinShares finds that institutional investors poured $125 million into the crypto markets last week, the second week of significant inflows in a row. Digital asset investment products saw a second week of inflows totaling $125 million, bringing the last 2 weeks of inflows to $334 million, representing almost 1% of total assets under management. Recent price appreciation saw assets under management rise to $37 billion during the week, the highest point since early June 2022, and matching the average assets under management for 2022. Trading activity remained high at $2.3 billion for the week, well above the US $1.5 billion year-to-date average. BTC took the lion's share of investors' inflows to the tune of $123 million. Bitcoin remained the primary focus of investors, seeing inflows of $123 million, with the last 2 weeks inflows representing 98% of all digital asset flows. Bitcoin investment products are now back to a net inflow year to date, having been in a net outflow position of $171 million just 2 weeks ago. Despite recent price appreciation, short Bitcoin investment products continue to see outflows totaling $900,000, representing its 10th week of outflows, which now represent 59% of assets under management. Despite this recent bearishness for short Bitcoin, it remains the second best performing asset in terms of inflows year to date at $60 million. While multi-asset investment products and Solana saw outflows of 1.8 million and 0.8 million respectively, other altcoins like Ethereum, Litecoin, XRP and Cardano enjoyed inflows of 2.7 million, 0.3 million, 0.4 million and 0.9 million respectively. Next up, we have 4 US banking giants now have $205 billion in unrealized losses sitting on balance sheets. That's 205 billion with a B, not million, billion. The 4 largest banks in the US now have a total of 205 billion in unrealized losses on their balance sheets, according to a new report. Bank of America, Wells Fargo, JP Morgan Chase and Citigroup have compiled the losses due to bad bets in the bond market, reports the Financial Times, citing fresh data from the Federal Deposit Insurance Corporation, the FDIC. Bank of America is in the worst shape by a significant margin, with $100 billion in unrealized losses on the books at the end of the first quarter. Wells Fargo and JP Morgan Chase both have $40 billion in unrealized bond market losses, while Citigroup has $25 billion in paper losses. Silicon Valley Bank is now the poster child, representing the potential pitfalls of unrealized losses in the banking system. The bank's rapid failure back in March was sparked by an announcement that the bank had booked a $1.8 billion loss from selling a portion of its bond portfolio. Bank of America has said its own bonds portfolio is not for sale, a move which could hinder the amount of money the bank can generate from deposits. The Bank of America has said it has no plans to sell the underwater bonds, avoiding crystallized losses that for now exist only on paper. The bank's portfolio consists of highly rated government-backed securities that are likely to eventually be paid back when the underlying loans mature. Despite the paper losses, the Federal Reserve says Bank of America and its peers fared well in a recent stress test on the banking system. The test, which simulated severely adverse conditions in the US economy, found America's top 23 banks would remain above their minimum capital requirements in a hypothetical recession, despite total projected losses of $541 billion. So there's going to be more pain to come from the looks of things, and when they talk about paper losses, it just means that these haven't really been materialized. So where Bank of America say they have no plans to sell their underwater bonds, that just means they don't want to realize the losses. They'll rather keep them on paper, essentially, so that they don't have to suffer the consequences of what that would actually mean, and hope for the prices to go back up so that they won't be at a loss at some point in the future. Miners send millions to exchanges. Next up, Bitcoin miners appear to be reducing risk as the significance of BTC price above $30,000 remains firmly in evidence. Bitcoin starts the first week of July with a sigh of relief for traders as $30,000 support holds. BTC price action refuses to succumb to bears after 20% gains in Q2, with weekly and monthly timeframes looking strong. What's next? A quiet week is expected on TradFi markets, with Wall Street gearing up for the Independence Day holiday and little in store in terms of United States macroeconomic data. Bitcoin thus needs volatility triggers from elsewhere if bulls are to have a shot at breaching resistance in place for several months. Views among market participants are mixed on this topic, as some believe that $32,000 and higher is easily achievable, while others consider this month the peak of Bitcoin's 2023 recovery. Cointelegraph looks at some of the major factors set to influence BTC price performance in the coming days and weeks. Short-term BTC price upside calls extend to $40,000. Bitcoin's weekly close was convenient for bulls, offering only modest volatility, with BTC USD pair continuing higher overnight. The new week saw a visit to $30,850 on Bitstamp per data from Cointelegraph Markets Pro and TradingView, marking the latest attempt at the $31,000 mark and yearly highs. Fuel for a trend change remains absent, leading more optimistic traders to wait and see when it comes to upside continuation. My Bitcoin plan remains the same, popular trader Gel summarized to Twitter followers in part of his latest analysis. Market structure is bullish. We've claimed the 200-week EMA. Once the $32,000 resistance area, I expect the bull market kicks off. Until then, we trade the range and buy deeper pullbacks. Gel referred to the 200-week exponential moving average, which, together with its counterpart simple moving average, continues to act as market support after a brief challenge in June. An accompanying chart showed the first major upside target as the current all-time high at $69,000. Fellow trader Crypto Ed hoped for a push towards $36,000 and even $40,000, while considering the likelihood of a retracement to $28,000 first, already a popular dip buying zone. Market structure, he said, remained good, despite last-minute volatility into the end of the month, with the BTC USD pair wicking to 29,500. And there's a Twitter post from ed_NL which says, BTC following my plan for 36 to 40k so far. Nice reactions Friday on red and green box. In my next YT update, I'll explain what I expect from here. One more ABC down towards 28k or up only ? Should be online around 10 AM CET. Meanwhile, on-chain monitoring resource material indicators noted Bitcoin whales' role in maintaining the BTC price range. No question, BTC whales have been distributing in the $30,000 range, but they've also been buying the dips, which have helped keep BTC in this range, part of further analysis added. As Cointelegraph reported, July has never seen more than 10% losses for BTC's price, but this is not stopping one popular trader, Crypto Bullet, from forecasting an end to bullish moves this month, predicting the area around $36,000 as the local top. Crypto Bullet predicts that the downside, including giving up the key moving averages, will come next. I'm not saying we'll dip to 20,000 this or next month. In my opinion, it will happen in Q4, he wrote in subsequent Twitter comments on his original prediction. So, a bit of a 50-50 opinion there. Personally, I would probably be on the more bearish side. I do believe we're going to see a local top soon, and that we will be having another leg down for the rest of potentially this year, maybe into the start of next year, due to macroeconomic effects like the interest rates and the effect of the rate hikes only being felt 12 to 18 months after they've started. So although the interest rates currently are around 6% in some places, like mainly like America, the US, those rate hikes won't really be felt until sometime next year, which is when I think the real pain will be happening, and certain countries in Europe like Germany and the UK are starting to go into recessions now. So this is just the start, really, and I do believe this is just a relief rally for a longer term downtrend. Next up, we have BlackRock Refiles for Bitcoin ETF after SEC flags flaws. After reports that the SEC found flaws in its initial filing, BlackRock submitted a fresh application for a Bitcoin spot market ETF. If successful, it would be the first Bitcoin spot ETF to win approval. BlackRock has submitted an amended application for an exchange-traded fund that would focus on Bitcoin spot markets after the regulators expressed misgivings about its first attempt. In a new filing submitted on its behalf by the Nasdaq exchange, BlackRock said that it will be finalizing a surveillance agreement with Coinbase, addressing one of the main objections the Securities and Exchange Commission has raised when rejecting applications for Bitcoin spot ETFs in the past. The spot Bitcoin SSA is expected to be a bilateral surveillance sharing agreement between Nasdaq and Coinbase that is intended to supplement the exchange's market surveillance program. Read the filing. The proposed ETF will rely on Coinbase, the second largest crypto exchange in the United States, as its custodian and for its spot market data for pricing. Coinbase also has an agreement to provide similar services to Fidelity, which is seeking its own Bitcoin spot ETF. Bitcoin prices surged after news broke that BlackRock, the world's largest asset manager with $9.5 trillion under management in the first quarter of 2023, was filing for the ETF. Since the filing was first reported on June the 15th, Bitcoin's price has risen by about 20%, especially as more firms piled in on submitting their own ETF filings. This bullishness was strong enough that the markets shrugged off a June 30th report in the Wall Street Journal that the SEC found BlackRock's application to be inadequate. The warning shot did not take long to resonate across the industry, with exchange operator CBOE quickly modifying its application for a spot ETF on behalf of Fidelity the same day as the Wall Street Journal report. Registering a Bitcoin ETF with the SEC has been a difficult task, especially for funds dealing with spot market trading. To date, not a single application for such a spot ETF has been approved by the SEC due to concerns about potential fraud or manipulation in the spot market. By contrast, the SEC has approved 4 Bitcoin ETFs for futures trading. An ETF is a type of investment product tied to commodities, currencies, stocks, or bonds. It allows investors to have skin in the game without actually owning a particular asset. A Bitcoin ETF allows investors to invest in the world's oldest and largest cryptocurrency without having to hold it themselves. Rather, they just buy shares that track the asset's price. So, I do believe eventually these ETFs for a spot Bitcoin ETF will happen. They will be approved. It's just a matter of time, and partially that's why I do believe we're going to have another leg down in the market and the price for Bitcoin, not only with the macroeconomic factors and the interest rates and things like that. These institutions aren't going to buy at a high price. They're going to wait until the price is very low, and I feel like that will be when the ETFs are finally approved, so that all these institutions can then flood in at the lowest prices and get the best deal. But I may be wrong. We'll just have to wait and see. That's my opinion. And finally, Bittrex accuses the SEC of failing again to define securities. Bittrex argues that the SEC has no right to regulate tokens because Congress has not clearly authorized it to do so. Bittrex, who is one of the exchanges that has been sued by the SEC, Bittrex, a bankrupt cryptocurrency exchange, is contesting the US Securities and Exchange Commission's authority to regulate its operations through securities violations. This dispute, if won, could limit the SEC's power to oversee cryptocurrency exchanges and other digital asset businesses. The first line of the motion read, "After a 6-year investigation during which the Securities and Exchange Commission refused to name a single cryptocurrency asset that it claims Bittrex unlawfully listed for the trading on its platform, the SEC has now charged Bittrex with multiple securities laws violations for failure to register." While the SEC states that Bittrex functioned as an unregistered securities exchange, broker-dealer, and clearing agency, the bankrupt exchange states that the Commission left them no choice but to guess which, if any, of the hundreds of other tokens traded on its platform might also constitute securities, in the Commission's view, as it was starting to shutter its US operations. The motion stated that Congress must give the SEC clear congressional authorization to regulate securities that are tokens, arguing that the Exchange Act or the Securities Act of 1933 does not give the SEC the right to flippantly declare tokens as securities. Bittrex claims that interpreting pre-digital era legislation must get congressional approval because sometimes old statutes may be written in ways that apply to new and previously unanticipated situations, but an agency's attempt to deploy an old statute focused on one problem to solve a new and different problem may also be a warning sign that it is acting without clear congressional authority, citing the case West Virginia v. EPA 2022. SEC versus crypto. The SEC has been actively targeting cryptocurrency businesses, accusing them of securities law violations despite giving evidence to the contrary. Coinbase filed a motion to dismiss on the same principle, stating that the SEC acted in an abuse of power. Coinbase argues that the SEC's lawsuit does not present a valid legal claim because the SEC's application of securities laws to these tokens significantly deviates from existing legal standards. For years, Coinbase has begged the SEC for guidance about how it thinks the federal securities laws map onto the digital asset industry, as the SEC's actions reflected an escalating but undisclosed change in its own view of its authority. And while industry leaders seek to fight against the establishment that is bringing them down, the Blockchain Association held up support, demanding that SEC Chair Gary Gensler steps down and recuses himself from this case. Now we all know that's not happening. It was fueled by AI misinformation, but let's carry on. The paper, written by the association's Jake Chavinsky and Marisa Koppel, argues that the SEC already has extreme biases against the crypto industry and how Gensler defines securities, while the Commission is unable to define securities despite being requested to do so. SEC Chair Gary Gensler has made clear that he takes a different view. In his mind, all digital assets other than Bitcoin constitute securities. End of story. So does that include Ethereum as well? Could we see some lawsuits against Ethereum at some point? I'm not too sure, but that's everything for today. Thank you all for tuning in and listening. All source links will be left in the description. If you enjoyed this video or found it helpful in any way, I'd really appreciate it if you would hit the like button and leave a comment to let me know your thoughts on today's news. Also, don't forget to hit the subscribe button and the notification bell so you don't miss out on future updates. I hope you all have a great day, and I'll see you all tomorrow.